Silver didn't crash because the story changed. Silver crashed because the dollar system tightened, leverage hit a wall, and the market was forced to sell first and explain later. That's the uncomfortable verdict. And the conflict is already forming. The clean narrative will be profit-taking after a monster rally, while the plumbing is flashing something sharper, funding stress, collateral hunger, and year-end balance sheets, slamming doors at the exact moment everyone was leaning the same way. The hidden mechanism most people missed isn't in the headline price at all. It's in what it costs to stay in the trade, and in what the curve and spreads were quietly admitting underneath. And here's the payoff I am going to give you before we even breathe. By the end, you'll have a simple next week checklist, a few price zones that matter more than any prediction, and one, if this happens, the math changes. Invalidation signal you can actually respect. Because this move wasn't emotional, it was math. And that's where the real pressure starts. Let's do the autopsy the way professionals do it, by starting with what changed mechanically. Silver had just put in a historic run in 2025, blasting to records around the low to mid-80s per ounce, and then, in a single violent swing, it dropped roughly 8 to 9% from the top, before stabilizing closer to the low 70s. A move like that feels like the floor giving out. It's loud. It's humiliating if you were late. It's euphoric if you were short. And it's exactly the kind of move that tempts your brain into one of two expensive stories. Either the top is in forever, or this is a gift and it can't go lower. Both stories are traps when the driver is liquidation. Here's the key. When a market is crowded and leveraged, price doesn't move to where it's fair. Price moves to where the forced seller is finished. That's a different destination. That's why you saw the air pocket. That's why it didn't feel like normal trading. And that's why the timing matters. This happened into year-end conditions, when liquidity thins, dealers protect balance sheets, and the cost of carrying risk can jump without warning. But that's not the part that matters. The part that matters is what forced participants to do. Start with the collateral problem. In futures, you don't get to simply believe in your thesis. You rent your position with margin. When volatility explodes, that rent goes up. And right as the market was whipping around, the exchange raised collateral requirements across precious metals futures: gold, silver, platinum, palladium. That's not a moral judgment, it's risk management. But mechanically, it does one thing. It demands fresh cash from everyone holding positions. Now picture the timing. Year-end, thin liquidity. Everyone's sitting on gains. Dealers are cautious. Funding is tighter. And then the rent spikes. If you can't post more collateral immediately, you sell. Not because you changed your mind, because you ran out of oxygen. And that moments where the move stops being a chart and starts being a funding event. Now, if you want to understand why people are calling this a dollar liquidity crisis, strip the drama away and make it plain. It means the system's ability to source dollars, cash-like funding, becomes constrained relative to demand. It's not about some apocalyptic shortage of paper bills. It's about the plumbing, repo markets, balance sheet capacity, collateral haircuts, and the rates and terms at which institutions can borrow short-term funding. When that plumbing tightens, you see the same pattern across markets again and again. Anything that was carried with leverage becomes fragile, and anything that requires smooth financing becomes jumpy. That includes precious metals futures, where leverage is a feature, not a bug. And here's the detail that should snap your attention. On December 31st, 2025, year-end, banks and eligible institutions borrowed a record amount from the New York Fed's standing repo facility north of 70 billion record. Not a little uptick, a record. That doesn't automatically mean catastrophe. It does mean the system had a moment where private funding wasn't as comfortable as it usually is, so the backstop got used at scale. The next detail is what flips the whole setup. This kind of stress shows up around calendar turns because balance sheets get defensive. Banks window dress, dealers ration capacity, and the cost of financing positions can spike right when markets are thinnest. That is exactly when crowded trades get punished. So when you see silver drop hard into that exact backdrop, the first question is not, did silver become a bad metal overnight? The first question is, who was forced to sell and why? Because if this was forced selling, the rebound profile and the next week risk are completely different than if this was a fundamental demand collapse. And that ES, where most retail narratives go wrong, they interpret a liquidity flush as a thesis reversal. Volatility loves that mistake. It eats it. Now let's connect the dots without turning this into a conspiracy story. You don't need shadowy villains to explain how markets snap. You need incentives and constraints. The exchange raises margins because volatility rose. Funds and traders have to post more cash or reduce risk. Dealers have less appetite to warehouse risk into year-end. Funding becomes more expensive and more selective, and then the market does what it always does in that environment. It finds the weak link. In silver, the weak link is often the leveraged long who chased the parabolic move late, because silver's volatility is not polite. It doesn't drift, it lunges. So here's the chain in clean mechanical steps. Volatility spikes. Margin requirements rise. The cash needed to maintain positions rises. Some participants can't or won't add cash. They sell contracts. That selling pushes price down fast. Price down increases stress because it hits P&L and triggers more risk limits. Risk systems cut exposure, more selling. That triggers stop losses and margin calls. And suddenly you're not watching investors changing their minds. You're watching a cascade, and that's why the drop felt like a trap door, because it was. But that's not the full story, because the hidden detail lives one layer beneath the headline. If you only watch spot price, you'll get emotionally manipulated. Spot is the loudest number, but not always the most informative one in a stress event. The curve, the spreads, and the paper versus physical signals can tell a different truth. And here's the hidden detail that reframes this entire move. When a commodity is truly becoming well supplied, time spreads usually relax. The curve tends to pay you to wait. The market becomes comfortable with carry. But in tight markets, you often see the opposite. Front-end stress, backwardation signals, or persistent dislocations between what paper says and what physical logistics can deliver. I'm not telling you the curve proves everything is fine. Why I'm telling you this. If the curve and spreads refuse to normalize while spot is dumping, that is a classic signature of a liquidity flush in a structurally tight market. The price is screaming fear. The spread is whispering scarcity. And that whisper is the part most people never even look for. Here's the simplest way to understand term structure without getting lost. Futures prices exist across time. Near month, next month, 3 months out, a year out. When supply is comfortable and financing is easy, longer dated prices can be higher because storage and financing cost money. That's contango, normal. When supply is tight or immediate demand is urgent, the front month can trade higher relative to later months, and because the market is effectively paying you to deliver now, not later. That's backwardation. And why does it matter? Because it tells you whether the market is encouraging inventory to come out of hiding or encouraging it to sit still. And that's where the real pressure starts. Arbitrageurs, refiners, fabricators, and large traders respond to these spreads. If the front is rich, it pulls metal forward. If the back is rich, it pushes metal into storage. Spreads are not just technical. They are the steering wheel of physical behavior. Now, in silver, there's an extra twist that makes this even more explosive. Inventory is not a single honest pile. There is metal that exists, metal that is available, and metal that is deliverable under the rules of a specific contract at a specific time. Those are not the same thing. In a stress event, the market doesn't care that metal exists somewhere on Earth. It cares whether it can be mobilized, refined to the right spec, delivered to the right location, and financed in time. Logistics and refiners don't teleport. Shipping doesn't become frictionless because Twitter got excited. And when the system is tight, little frictions become big spreads. So, if you want to understand why silver can dump 8 to 9% and still not prove the tightness story wrong, you look for the deeper signals. Do near-term spreads stay stubborn? Do physical premiums stay sticky? Do delivery constraints and procurement behavior remain tense? Do fabricators hesitate to sell forward aggressively? Do hedgers act defensive? You don't need perfect numbers to look for these behaviors. You need the right mental model, because if you read the wrong model, you will get played. Now let's talk about the institutional behavior that makes these moves nastier than they look. ETFs and large pools of capital are often treated like smart money, but mechanically, they can become forced participants too. When investors redeem, an ETF can be required to sell or adjust holdings. That selling can line up with futures deleveraging. Add that to exchange margin hikes. You get a moment where the market is flooded with sell orders that are not expressing a nuanced view. They're satisfying constraints, and constraints don't care about your thesis. Meanwhile, the other side of this trade, the institutions that can buy in distress, are often waiting for one thing: stabilization in funding and confirmation that the flush is done. That's why the first bounce after a liquidation event can be violent and confusing. Shorts cover, weak longs are gone. Liquidity returns, price rips, then it retests, then it decides. The next detail is what flips the whole setup. Year-end and early January flows can change the character of the market fast. Funds rebalance, risk budgets reset, dealers reopen capacity, and the same crowd that panicked out can chase back in at worse prices. This is how volatility harvests emotion. So let's anchor the evidence stack so we don't drift into vibes. Proof point 1, the margin hikes. When collateral requirements rise into volatility, it's gasoline on an already crowded trade because it forces cash to appear. If cash can't appear, positions disappear. That's mechanical selling pressure. Proof point 2, the year-end calendar trigger. Thin liquidity around the last week of December is real. Spreads widen. Order books get shallow. A normal sell becomes a cliff. The market doesn't need a big seller to move big. It just needs a fragile book. Proof point 3. The record usage of the standing repo facility at year end. That's the plumbing admitting strain. Not apocalypse. Strain. It tells you dollars were worth more than usual in that moment, and participants were willing to tap a backstop to secure funding. Proof point 4. The sheer profile of the rally before the drop. Silver wasn't drifting higher. It was parabolic. A parabolic move creates positional imbalance. It builds leverage. It attracts momentum. And when that breaks, the unwind is fast because everyone tries to exit through the same door. Proof point 5. Cross precious pressure. This wasn't silver in isolation. When gold and other precious metals also get hit alongside margin adjustments and year-end positioning, it supports a deleveraging frame more than a silver-specific demand collapse frame. Proof point 6. Flows and risk management behavior. Even without pretending to know every institution's exact book, you can see the signature. Rapid drops, fast rebounds, whipsaws, and a market that punishes both sides if they're emotional. Now, the counterpoint matters because skepticism is what keeps you solvent. There's a bear case, a serious one. Silver had surged so far, so fast, that a violent correction is normal even in a longer-term bull structure. Profit-taking can be rational. The market can overshoot both directions. And if global growth expectations wobble, if industrial demand is questioned, if real yields rise sharply, or if the dollar strengthens aggressively, silver can keep correcting. Also, if the curve and physical signals truly relax, if tightness evaporates and the market pays you to wait again, that would be a clean sign the story is cooling. But here, don't axe the trap. The bear case and the bull case can both be true in different time horizons. The bull case can be structurally true and still deliver a brutal drawdown in the short run. That's why serious investors don't worship direction. They worship process. Because if you confuse time horizons, volatility will turn you into a headline addict, and headline addicts get chopped up. So let ES translate this into something actionable for the next 1 to 2 weeks, without pretending we can see the future. First, understand what a liquidation event usually does to chart structure. It creates an air pocket down, then a reflex bounce, then a test of a zone that used to matter. In this case, the record area up in the low to mid-80s is now a psychological ceiling. Not because it's magical, but because it's where late buyers got trapped and where sellers remember easy money. Below that, there's usually a band, call it the mid to upper 70s, where the market has to decide whether it can reclaim the breakdown. And below that, there is a line in the sand near the low 70s and potentially into the high 60s, where the "this was just a flush" thesis starts to strain. I'm not giving you a single number. I'm giving you zones, because zones are how markets behave in real life when volatility is high. Now here's the simple next week checklist, and each item has a reason. Watch funding stress. You don't need to be a repo trader. You just need to notice whether the system is still leaning on backstops and whether short-term funding feels tight or easing as January liquidity returns. If funding eases, the market often regains stability quickly. If funding stays tense, volatility stays elevated and metals can whip again, even if the longer-term story is intact. And that's where the real pressure starts. Watch whether the exchange keeps tightening collateral. One margin hike can be absorbed. Repeated hikes can grind leverage out of the system and keep pressure on paper positioning. If volatility stays wild, collateral tends to stay high. If collateral stays high, speculative leverage stays lower. That changes the speed of upside moves. Watch the curve and spreads. I'm going to say this as plainly as possible. If spot is down but near-term tightness signals remain stubborn, if time spreads, dawn to fully relax, then the flush likely cleared leverage more than it cleared the underlying tightness. If, on the other hand, the curve goes complacent, carry gets attractive, and front-end stress disappears, that's a sign the immediate squeeze pressure may be fading. Because if this one layer changes, the math changes. Watch behavior around the reclaim attempt. Strong markets don't just bounce, they reclaim and hold. Weak markets bounce and then bleed. If silver can reclaim a key band and hold it on retests, even while the news is still loud, that's a signature of stronger hands stepping in. If every bounce gets sold hard and the market can't hold reclaimed ground, then the path of least resistance stays down or sideways. Watch positioning psychology. This is less about data and more about pattern. After a parabolic move and a crash, the crowd becomes jumpy. They anchor to the top. They start chasing rebounds. They panic on red candles. That's the environment where market makers and larger participants can use volatility, not by manipulating anything illegally, but by letting the natural structure do its work, shaking out impatient money, triggering stops, and harvesting emotional decision-making. You don't need to accuse anyone of anything to acknowledge the incentive. The incentive is built into how fragile attention behaves, and that brings us to the viewer psychology shield. because this is where you either keep your discipline or become the market's lunch. Silver will whip around violently, even if the longer-term thesis is correct. Let that sentence sink in, because most people only accept volatility after it hurts them. The correct frame is this: a trend signal is not the same thing as short-term noise. Trend signals are things like structural tightness, persistent demand, macro regime shifts, and curve behavior over time. Noise is the intraday and day-to-day turbulence caused by funding, margins, positioning, and liquidity. In a liquidation event, noise gets louder than the signal. That's why it feels like the world ended. Your brain will try to protect you by narrating. It will label every candle as proof. It will look for villains. It will interpret a bounce as certainty. It will interpret a dip as betrayal. That's not analysis. That's physiology. You're wired to respond to threat. The way you beat that wiring is by pre-committing to a process. Zones, scenarios, invalidation, and time horizon. If you don't do that, volatility will drag you into buying high and selling low while feeling informed. So here's the two-scenario lens that keeps you sane, even if you never place a trade. Scenario 1 is the controlled pullback and retest. In this scenario, the crash was primarily a leverage flush driven by margin stress and thin year-end liquidity. Funding conditions normalize as the calendar turns. The market rebounds, then retests a zone, often around the breakdown band, without making new lows. Spreads and curve signals remain relatively firm. Price starts to build a base. Confirmation looks like reclaiming and holding key zones on dips, less frantic volatility, and fewer gap-like air pockets. The risk in this scenario is still real. It can retest deeper than you expect before stabilizing. But the signature is that it stops bleeding and starts absorbing selling. Scenario 2 is the continuation squeeze in both directions with gap risk. This is where it gets spicy and dangerous. In this scenario, the market doesn't simply calm down. It stays volatile because positioning is still unstable and liquidity is still thin in patches. You can get violent down days that feel like collapse, and then violent up days driven by short covering and hedging. If the market snaps back above a key band quickly, shorts that leaned into the breakdown can get trapped, and the move up can be sharp because liquidity is still not deep. This is where people get emotionally destroyed. They sell the low, then watch it rip without them, then chase the rip, then get dumped again. Confirmation looks like explosive rebounds, aggressive reclaim attempts, and continued whipsaw. The risk is gap risk, moves that happen when you're not ready. And that's why, regardless of your view, you respect volatility as a weapon the market naturally uses. Now, what would weaken or invalidate the "this was mainly a liquidity flush" thesis? You don't need 10 indicators. You need 1 or 2 honest ones. One invalidation signal is sustained failure to reclaim and hold key zones, while volatility stays elevated and funding stress doesn't TEs. If silver repeatedly bounces and gets rejected hard, and the market keeps making lower lows into early January as liquidity returns, that suggests this isn't just a year-end aberration. Another invalidation signal is if tightness indicators truly relax, if the curve becomes comfortably carry positive and the market stops paying for immediacy. If physical and paper signals both cool simultaneously, then the structural squeeze story could be pausing. And if the dollar strengthens aggressively alongside rising real yields, that macro cocktail can keep pressure on metals even if the long-term thesis remains alive. Because if this one macro layer shifts, the math changes. But here is the nuance that separates a disciplined investor from a headline chaser. Even if the flush thesis is right, you still don't get to skip risk management. You still size for volatility. You still allow for ugly retests. You still respect that markets can overshoot. A good thesis can be delivered through a brutal path. The market doesn't reward you for being right on paper. It rewards you for being positioned in a way that lets you survive the path. Now let's address the emotional core of what just happened, because it matters for trust. A lot of people feel betrayed when a market they believed in drops 8 to 9% in a day. They feel like something is wrong. But in leveraged markets, big down days are not proof of fraud. They're proof of fragility. If the structure is stretched and the financing cost jumps, the unwind is the unwind. The market doesn't owe you a gentle exit, and the faster you accept that, the less you'll get manipulated by it. And here is the quiet reality that nobody wants to say out loud. A violent flush can actually strengthen the setup later, because it removes weak leverage and resets positioning. Not always, not guaranteed, but often. That's why you must separate your emotional reaction from the structural picture. That's why the hidden detail, the spread and curve behavior, matters. Because spot can lie to you during a cascade. Constraints speak louder than conviction. So what comes next, right now, this week, and into the next? Expect the market to test you. Expect headline whiplash. Expect it is over narratives on red days and new paradigm, narratives on green days. Expect people to point to the same chart and tell opposite stories, and then ignore the noise and track the checklist. If funding eases as January liquidity returns, and silver can reclaim a key band above the immediate post-crash zone, you can get a fast stabilization and a structured retest that sets up the next leg. If funding stays tight and collateral remains expensive, you can get more forced selling, more sharp spikes, and a market that chops both sides. If silver loses the low 70s area decisively and can't recover quickly, then the market is telling you it wants a deeper reset, possibly into high 60s territory, before it can build a base. If silver reclaims the mid to upper 70s and holds it through a retest, the probability shifts toward flush and recover rather than flush and bleed. And if it ever starts reclaiming the space toward the low 80s, that's when the short side gets dangerous again, because memory works both ways, and trapped shorts cover fast. But that's not the part that matters. The part that matters is you don't get emotionally drafted into someone else's time frame. Here's the subtle CTA, and I am putting it where it belongs, near the end, after the value. If you're still here, you're not looking for hype. You're looking for mechanics, incentives, and a roadmap you can actually follow when your feed is screaming. Stay in that identity. Use the comments like a war room, not a therapy session. What did spreads do? What did funding stress do? What zone held? What zone failed? And what would change your mind? That's how you build trust. In your process first, then in your positions. Silver dropping 8 or 9% in a day is not a normal day. It's a stress signature. And the dollar liquidity crisis, framing only matters insofar as it explains why stress can spill into assets that look unrelated on the surface. The exchange raising margins matters because it forces cash. The Fed's repo backstop usage matters because it hints at year-end funding tightness. The calendar matters because liquidity and balance sheets behave differently at the turn. And the hidden detail matters because it tells you whether this was just a crowd being flushed or whether the deeper structure is changing. So hold the two scenarios in your head. Controlled pullback and retest, or ongoing volatility with squeeze dynamics and gap risk. Track your zones, respect your invalidation, and never let a single day's candle rewrite your entire worldview. Because if this was a forced move, the market's next job is to lure you into making a voluntary mistake.